Hey everyone, Jeff Dorman, Chief Investment Officer at Arca, back again for another edition of That's Our Two Satoshis Live, where every Tuesday we talk about what is happening in the crypto markets. This is not financial advice, but we talk a lot about what's happening in markets, so obviously there's going to be some investment thoughts. We've been doing this every week now for almost 7 years. You can read the blog yourself if you're more of a reader. That's Our Two Satoshis on the Arca website. But let's talk about what happened in the markets last week. So first of all, if for those who actually watch this every week or read every week, a lot of the last few months, actually, we haven't really been talking about week over week price action because it's been kind of boring in crypto. But a lot happening in the equity market, a lot happening with IPOs and digital asset treasury companies, a lot happening in Washington with politics. There hadn't been a lot happening actually in the crypto markets themselves from a price action standpoint. That changed last week. This we have to go back to talking about markets again because crypto was flying last week, and honestly, it seemed inevitable. We've been talking about this most of the last 4 months, which is with equities at all-time highs and gold at all-time highs and Bitcoin at all-time highs and crypto stocks at all-time highs and a plethora of new digital asset treasury companies raising money with what seems to be insatiable and endless bids. It was only a matter of time before the tokens of the companies and projects that power all of these ancillary crypto businesses would actually get a bid themselves. And that's what happened last week. But more importantly, what was interesting is where the bids really came from. A lot of people will say crypto's up year to date because Bitcoin's up year to date. But if you actually look at the individual tokens, most tokens are down anywhere from 30 to 60% year to date. There's only a handful of tokens like Ripple and Bitcoin, which have obviously benefited both from institutional demand as well as from Washington politics, and maybe a couple others that are just cash flow machines like your Hyperliquids and your Maple Finances that are positive year to date. Most tokens have just gone straight down starting in January and really haven't recovered, even though things are higher from the April 8th lows. Meaning if something goes down 90% and then it goes up 100%, it's still down 80%. So the big rally we've seen over the last 3 months has not been nearly enough to offset the weak price action. But last week was different. There was some real bottom fishing. Most of the most beaten up tokens year to date were actually the tokens that went up the most last week and month to date. In fact, we put a chart from Masari in the blog showing this, and shout out to Masari. I think they actually do a nice job with sorting by different parameters, but really kind of stark performance differences between the first half of 25. Between the first half of 2025 and the last week and a half here. So big gains by the biggest losers, but that's not unique to crypto. In fact, equities are doing the exact same thing. If you look at 24 of the 25 biggest equity losers in the US in the first half of 2025 are now up the most in July. So we're seeing that sort of triple C rated rally or that kind of flight to low quality bid in the market. And that might scare some people. Historically, when you start to see the dino coins or the terrible coins, starting to go higher, whenever these like really, really bottom of the barrel, low quality assets start to rally, usually that's sort of something that shows sort of the sign of the end of a rally rather than the beginning. But the flip side of that is that now that prices are going a little bit higher, and again, still meaningfully lower year to date, it's not even like this has been a good year. Now that you're starting to see some of these prices going higher, there is a little bit of a flywheel effect there, right? The decentralized exchange volumes go up, the centralized exchange volumes go up. And when those volumes go up, that makes the DeFi tokens go higher because they're getting all kinds of cash flow and buybacks, and it makes the exchange tokens go higher for the same reason. And that starts to get people more excited. So you do see reasons why this wouldn't necessarily mark anything close to the end. But also a shout out to, I believe it was Will Clement, who put out a nice post talking about another reason why this isn't anything like historical tops is that normally you would see, quote unquote, altcoin open interest flying relative to Bitcoin anytime you were near a top. And we're not even seeing anything close to that, right? This is literally just a week of good price action after 5 months of horrific price action. So it does feel more towards the bottom than it really does the top. But, again, I'll say that bear markets are always easier to trade than bull markets. I've said that my whole career because, at least in bear markets, you have time to think and you can really pick up cheap assets. Whenever things are rallying, it's always hard because it gets the data gets confusing. You have conflicting opinions from algos and day traders and retail piling into things that maybe don't make sense. So it's always a little bit harder when things are rallying like this. But I'd say with so many positive events happening in crypto right now, it's hard to focus on the nonsense assets that are going higher. Instead, I think it's more important to focus on the assets that are going up, that should be going up, right? Again, these cash flow producing assets, and assets that are being put into digital asset trading companies, assets that are starting to benefit from the growth of stable coins and the growth of banks and brokerages getting involved with tokenization. So a lot of positive things to look at, even if some of the other things on the kind of outskirts don't make a lot of sense. What is probably more important this week, and what I'm most excited about, was the Pump.fun record token launch. So for those not familiar, Pump.fun is a launch pad for meme coins. They have aspirations to be much bigger than that. But for all intents and purposes, it's just a place to launch meme coins. But it's a cash cow. They make anywhere from 500 million to $1 billion of run rate revenue, depending on what time frame you're looking at, all through these token launches and through the bonding curve that happens thereafter. It was only a matter of time before they issued a token. And we've written a lot about the launchpad wars, Bonk.fun, and the effect of Radium, and even Launchcoin to some extent. So there's a lot going on with these kind of launchpad exchanges that help you issue a token quickly. But the most important thing about Pump.fun is not what they do, it's how they issued the token. Most of you know I've been on record for a long time talking about how just these direct listings from Coinbase and Binance and all the exchanges are just a disaster, right? They just arbitrarily take a token and some random price that the VCs or the token issuer or the market makers tell you to price it at. It prices at some egregiously high level. It goes straight down. 5 years ago, you used to buy tokens that got listed on Coinbase because you thought it would generate extra demand. Now the first thing you do is sell a token when it gets listed on Coinbase because you're like, okay, these guys are going to price it wrong and it's going to go straight down. Pump.fun changed that, and they did a token raise the right way. So the reason these token launches have always gone straight down is because there was no price being set. There was no actual sale of tokens. There was no clearing level where demand met supply. And as a result, again, they could just arbitrarily list it at a high price. Pump.fun decided to sell tokens. They did what, similar to what an old ICO or similar to an IPO. So what they did is they spent a couple of weeks doing a private round to institutional investors, guys like Arca and other funds who get looks on those private rounds, to figure out what the clearing price was at this, and that came around $4 billion in terms of a market cap. And then once they figured out that that was the price where it was going to clear in the private rounds, they went out and they said, we're going to do an ICO for retail at the exact same price. So this is the big difference between this launch and everything else, is they actually went out there and found where $1 billion worth of demand lives. In fact, it was probably closer to 3 to 4 billion of demand. They could have sold way more. And that's the way IPOs work in the stock market. That's the way bond deals work. You come up with an actual price where there's more demand than there is supply. And that's why stocks go up after IPOs. That's why bonds go up after bond listings. Same thing happened here. So they found probably 3 billion worth of demand at this $4 billion market cap. They only priced $1.2 billion, and as a result, it's now trading 50% higher than where they priced. That's a huge win for the crypto markets. Hopefully, this shows all these other exchanges how to do it the right way. Hopefully, it shows all you token issuers how to do it the right way. There's no benefit to listing a price super high and watching it go straight down and pissing off all your customers and all your investors. You want things to go higher. That's why every investment bank in the world has league tables where they actually show off how their deals perform after 1 day, after 7 days, after 30 days, after 90 days. Because guess what? Investment banks want to entice their investors. They want the investors to come back. They don't want them to feel burned. And they want to entice future stock and bond issuers, saying, hey, we can price it at a level where it goes higher and you all make way more money. It's the exact opposite of what Coinbase and Binance have done for years, where they say, price it at the highest price possible and just watch it go down. And all of your customers just get pissed and stop coming back. Like, I truly believe a big reason that crypto has been stuck in the mud for 2.5 years is because of these poor token launches. Hopefully Pump.fun has set a new precedent. We're really happy that they did this. And it's not a surprise that a company that has real revenue and real cash flows, with a portion of those cash flows being used to buy back the tokens, that prices at a reasonable valuation, right? $4 billion on a company that's doing $1 billion of revenue is not an egregious price, that the token's going higher and that people are happy. That's how you're supposed to do these things. So who knows where Pump.fun's token trades in 6 months or 12 months or 24 months. Eventually market forces take over and it's not about the launch anymore. But in the first 30 to 60 days, it is about the launch. And the launch went well. Congrats to Pump.fun. Congrats to those who have been involved in this. And a shout out to every other token issuer out there or future token issuer, all the VCs, all the market makers, all the exchanges. Stop doing it the way you've been doing it. It sucks. It's wrong. It's killing the market. This is the way to do it. If anybody wants any more details, check out the blog, read it there. Otherwise, we'll be back next week. That's our 2 Satoshis for this week. Thanks for listening, everyone. Take care.